Shares of Starbucks this morning are a little changed after the coffee giant reported strong international sales boosted by China's recovery. Same-store sales did come up short of analyst expectations. Rachel Ruggeri is Starbucks CFO. She's joining us now alongside Yahoo Finance's Brooke De Palma. Rachel, always good to see you here.
Hi.
Hi.
Hi. Morning.
Good morning. You've had your coffee, clearly.
A lot of it.
So, Rachel, let's talk about, in particular, what you guys are seeing in the U.S. I want to start there and with the same-store sales growth in the U.S. and what you're seeing in terms of traffic trends versus price trends, how all of that fed through during the quarter.
Sure. We would start with the fact that we had a 7% comp. And of that comp, about a point came from transactions. And we're seeing growth across the board year over year in every single day part. And so that's a good indicator of the health of our business. In addition to that, our ticket was 6%, which is elevated. But I think what's important in our ticket is there's a balanced contribution both from strategic pricing, but also from increasing customization and record food attach. And that's important because that shows a volume or a unit component to our ticket. And so when we look at that, that's what's driving the record demand that we're seeing in the U.S. business, which led to our average weekly sales being a record this quarter. You take the combination of the transactions and the ticket with overall new store growth, and we're seeing our average weekly sales the highest we've seen in the history of our company. So it speaks to the demand we're seeing, as well as the record engagement across of our customer group. And we're really encouraged by those signs. I mean, there's a lot happening in the economy, but for us, our demand remains very strong, and we're encouraged by that. And we're continuing to fuel it with the innovation that we're making in terms of our offerings, as well as the increasing digital capability we have and the convenience channels that we're growing. We saw delivery grow this quarter from 4% of sales this quarter. It was just about 2% of sales about a year ago. So we're seeing demand continuing to increase, and we think it speaks to the strength of the brand, but also the loyalty of our customers.
And Rachel, a quick follow-up on that. Last quarter, you told us that you expect price increases to return to a more normalized level of 1% to 2%. Are you still expecting that?
Yes. Yes, in the fourth quarter, we'll have fully lapped the pricing moves that we made last year. And so we've benefited this year from the annualization of those pricing moves from last year. So we'll start to see our ticket normalize from a pricing perspective. But we still believe our ticket will be elevated because we have this ability to continue to drive customization, a mix to more premium beverages, as well as increased attached. Our reinvention plan goes directly at creating the capacity in our stores to be able to serve our customers' needs around customization and attach. And that'll show up in an elevated ticket. So we're encouraged by the demand that will continue to fuel both in our stores as well as digitally.
Rachel, I listened to your earnings call yesterday, and one of the things that stood out to me was modifiers,
Yes.
like the cold foam, et cetera, and how that accounts for around $1 billion in revenue annually. How much more can you all squeeze out of that before consumers say, Uncle?
Yeah, I think it really comes down to creating the capacity in our stores to serve that demand. Our reinvention plan is positioned to be able to create a more stable environment for our partners, and that's through wages and through better training, and that's helped to stabilize the environment, bring the turnover down, and stabilize the environment. In addition to that, we've made investments in equipment and in our processes, and that helps with overall throughput. And that throughput helps us to be able to support customers' desires to customize. We don't think that's going away, and we actually have a very deliberate way to innovate and further our customization over time. But it's important to make sure that we create the capacity so that we create a good experience for our partners in serving that with our customers. And our customers naturally customize. So the more we can innovate in that space, I think we have a lot of opportunity ahead. And when we talk about modifiers, that's the same as customization. And that leads to strength in our ticket and has a volume component which supports the demand that we're seeing.
Rachel, as we've talked about before, cold foam is a big modifier that is popular in these parts, in this office.
Yes.
I was also struck to see that 75% of the beverage sales are now cold beverages. And this wasn't even in the height of summer when it's super hot.
That's right.
Is this a secular change in how people consume coffee? Is this is this just what it is now, that people are going to drink cold coffee year round and that's it?
It's definitely skewed more towards a younger consumer. And so we have a large consumer base of millennials and Gen Z, and their taste and preferences tend to be more cold. Now, I'm way over Gen Z, and I love cold espresso. But it is definitely an increasing trend, and we don't see it going away. What we are encouraged about in the quarter is that our beverage grew 10%, and that was a combination of growth in both hot and cold. So we did see growth of about 2% weighted on that 10 from a hot perspective, but we also saw cold grow about 8%. So we continue to innovate in both areas so that we can, offer coffee and continue to lead in coffee for all of the different customer tastes and profiles, but definitely cold is a big opportunity for us, which is why you see us continuing to innovate in areas like ice shake and espresso and refreshment, and even with our new blended lemonade refreshers. Those are all areas for us to be able to continue that growth in cold, which not only grows in the morning, but actually has a position across all day parts. So we see a lot of opportunity ahead, but it's definitely not going away.
And one investment that got a lot of buzz this past quarter among consumers is those new ice nuggets that you guys are switching over to. How much money do you expect to save at the end of the day with this investment? And what's the response so far?
Well, what I'd say is we're in the early journey of what we call our nugget ice, and being able to put nugget ice in our stores. We've hit our highest volume cold stores so that we can actually support the capacity. And that's largely what the nugget ice is about. It's to be able to support the capacity of the cold demand. And so we'll continue to roll out across our stores. Early on, what we're seeing is it's better for partners. It's easier in terms of overall, it blends faster. Well, eventually it'll be piped into the stores, so they'll no longer have to be, carrying buckets of ice. And so it's a better option for the partners and creates a better experience. But at the same time, our customers love it. And so the combination of that, gives us confidence that we'll be able to continue to fuel the growth, cold growth that we see, with improvements and advancements like nugget ice.
And hitting on those employees on the back end really quick, you did see baristas leaving improved by 11%. You saw take-home pay jump 20% year over year. But Lax did hint on some further improvements for baristas, for employees, you guys making month over month. Any sort of insight you could provide there? And also, can you provide an update on where you stand right now with bargaining with those unionized stores?
Yeah, I'll start with the fact that from a bargaining standpoint, what I would just start with is, from a unionization standpoint, we continue to believe that a direct relationship with our partners is best from not only a culture, but the experiences that we value. But we support our partners' decisions when it comes to, determining if they want to be part of a union, and we'll continue to bargain in good faith. What we're focused on is how do we continue to leverage our reinvention to create the very best experience for all of our partners. And part of that comes from the investments we're making in our business, the investments we're making in things like nugget ice, as an example, but also the investments we're making to create a more stable environment. And more recently, what we talked about on the call was that we're trying to find the right amount of hours for our partners. That comes through advancements we're making in staffing and scheduling. And we're on a journey. We've made some progress, but we have, a journey ahead of us. But we're encouraged by the early signs that we're seeing because it's helping to reduce turnover and create a more stable environment. And that stable environment's better for partners. It creates a better experience, but it's better for customers. So we'll continue on that journey. And more specifically, what we've done is we've taken our staffing model in-house so that we continue to innovate on a more store-by-store basis. And that way we're more targeted in the investments. I think the real opportunity for us as it comes to labor and the investments around labor is to be more targeted on a store-by-store basis. When you think about how important personalization is and customization is in our business for our customers, it's that same sort of concept for our partners. The more we can personalize the experience, and that comes through the hours they need, the benefits they need, that's where we have tremendous opportunity ahead, largely from an engagement standpoint, which we know is a key driver of the value of the Starbucks experience.
Rachel, I want to ask you about the China story and the penetration in China. So the average Chinese consumer only drinks about a dozen cups of coffee a year. I find that shocking. I mean, I drink that, and I won't say a week, but what are you all doing in terms of penetration there, especially when you need to, say, account for some slowing of sales growth in the U.S.?
Yeah. You know, for us, what that speaks to, that 12 cups of coffee, really speaks to the demand. I mean, this is one of the largest consumer markets in the world. And so we see the demand is increasing for coffee. And so what we're focused on, even though we're in the early journey of recovery, what we're focused on is how do we differentiate ourselves? And so we continue to focus on innovation, as well as increasing our omnichannel capability. That gives customers multiple different ways to interact with us. And we're also continuing to focus on opening new stores because that allows us to continue to bring in new customers and create new occasions. And all of that's underpinned by an experience that our partners create for our customers each and every day with every single visit. We think that that's the value of the Starbucks experience that's going to help not only in the near term, but support our long-term growth ambitions in the market.
Rachel, finally, back here in the U.S., we were very focused this morning on Fitch Ratings' downgrade of U.S. debt, which is, I realize, outside your purview, but I am curious. You know, one of the reasons that Fitch is pointing to here is the dissent that we are seeing in government, the effect that has on fiscal policy, et cetera. Mm-hmm. And I just wonder how you guys are thinking about that issue as a potential threat to economic growth going forward in the United States.
Well, it's incredibly important, which is why we've been focused on continuing to operate within a 3 times leverage ratio. So that's the guide that we keep so that we can maintain our BBB+ rating, but also it allows us to be able to support, I'd say, a more conservative stance in terms of our overall financial health. You know, we have a strong balance sheet. We're strong from a financial perspective. And so it's important for us to continue on the journey as we see, you know, interest rates continuing to increase and I'd say some instability in the overall macroeconomic environment. So our financial fundamentals are in place and I would say position us well to be able to grow in the future.